Joining me live now is the Executive Chairman of Yellow Brick Road Home Loans, Mark Bouris. Good to see you on a Friday. Now, let's chat inflation. Is it a sleeping giant? Good morning to you, by the way.
G'day, Peter. How you going? It's great to be in the studio for once. Is it a sleeping giant? Yes, it is a sleeping giant. But the main issue here is whether every single element of the inflation pool, all the various goods and services that get put into the inflation pool, there's like hundreds of them, whether or not everything is actually going up. And they usually don't go up in price, which creates inflation, unless we earn more money. Now, this might all sound a bit circular, but unless we're earning more money, we tend not to spend more money. There might have been a rush over the past 3 months to buy things. That's just pent-up demand. The question is this sustainable? And that's what the Reserve Bank's looking at. Is this going to be in a sustainable period of price increase?
Sorry, just on that point there, that's the problem, isn't it? That wages are flat and have been for some time.
Yeah, so we effectively had a wage recession in Australia probably for the last 10 years. We haven't really had wage increases. There's only one sector that has had wage increases over the past period, and that's the public service sector. And in particular in some places like Victoria, where public servants have been getting increases in wages. But generally speaking, you're right, Pete, the wages in Australia and salaries in Australia have not gone up. We need more money in our kick to go and spend more money on goods and items. So the Reserve Bank also said we will not be putting up interest rates until the Reserve Bank sees a national average increase in wages between 3 and 4% per annum. Now, we haven't seen something like that for a hell of a long time. So they put that in there as a rider. It's a proviso. Yeah. So look forward to low interest rates whilst ever wages are not increasing, irrespective of inflation.
So do you see there being a bring forward, so to speak, of the RBA increasing rates at all before 2024, which is the current estimate? Do you see it happening before then?
Right now I don't, because I don't see wages increasing, because businesses can't afford to pay higher wages, except in some industries. Now, we talk about averages. They always talk about averages. They can't say, we're only interested in wage increases in financial services or the media. They've got to have a look at wage increases across the board. So there are some industries like retail, for example, where it is very hard to get staff, hospitality, etc., farmers, blah, blah. So because the immigration numbers have dropped off. So as a result of that, these employees have to pay more money. So the question will be, has the increases in wages, or will the increases in wages as a result of low immigration end up giving us, on average, across the board, an increase between 3 and 4%, so much so that the Reserve Bank will get nervous enough to increase interest rates?
Okay.
As well as having a bit of inflation between 2 and 3%. So that's going to be the question. And that's a federal government call, because the federal government has to make sure that they get us enough immigration to fill those vacancies out in the farms, cleaning companies, etc.
Okay, so RBA aside though, many are expecting the banks to go with out-of-cycle interest rate rises. Some are even predicting there could be as many as 4 or 5 next year, which you'd have to think would have a pretty serious effect on people who need to pay back their mortgages, Mark, and particularly for those who've overindulged.
Now, that's a very good point. So irrespective of what the Reserve Bank does, we have markets in Australia which set interest rate prices. So in my business, for example, we have to go into the market to buy money, and the money is determined by demand and supply within the market, irrespective of what the Reserve Bank says. So there are people in the market who are predicting, outside of the Reserve Bank cycle, interest rate rises. Therefore, the cost of money to lenders, banks, myself, is much more than it has been, which means that our margin is getting compressed between the cost of money and what we lend it at. So there's only one way for us to go, is to either cop it on the chin and get less margin, or what tends to happen is everybody tends to push their retail rates out. So you're right. What could happen is if this persists, this cost of funds increase persists, all lenders will increase their interest rates. And again, you're right, we've borrowed so much money that if interest rates increase by more than 50 basis points, we're going to have a problem here.
So are you finding people are refinancing, right?
Oh, totally. So everybody's worked this out, like people listening to your show, obviously, and other people. They're listening to Peter Switzer and other people like that, and they are starting to think that what you just said may well happen. So therefore, they're saying, how do we get ourselves set? So they're going out and they're finding who is the cheapest lender in the marketplace, who's got the best fixed rates, who's got the best variable rate. They're going along to the mortgage broker and they're getting refinanced. We have seen an enormous out of cycle refinancing of borrowers that I've never seen in as long as the last 40 years that I've been in business. I've never seen that much refinancing, and everybody's getting very clever. And it costs you nothing. You go along to a broker, you don't have to pay the broker. Broker says, I'll get it sorted for you in the next two or 3 months. Refinance you, and some people, by the way, getting cash back as well. They're getting refinanced and getting $4,000 or $5,000 cash in their account as part of the incentive to refinance their loans. And then that's good. We want people to refinance and get set in a lower interest rate environment.